China's biggest life insurer boss imprisoned in Xi's corruption crackdown. China's real estate woes deepened, Sino-Ocean Group suspended offshore debt payments. Moody reduced China's real estate rating to negative. Why foreign investment is leaving China and what it means. It's all covered in today's China Truths. China's biggest life insurer boss imprisoned in Xi's corruption crackdown. Wang, the former chairman of China Life Insurance, China's biggest life insurer, has become the latest target of Chinese leader Xi Jinping's corruption fight. According to the court ruling, Wang was found illegally taking about 325 million yuan, $45 million, worth of bribes and hiding overseas deposits of 56.4 million yuan, $7.8 million. The ruling judged that Wang received the bribes in the 1997 to 2021 period, when he headed a number of state-owned financial institutions, including China Life Insurance, China's Bank of Communications, and China Taiping Insurance. He was accused of concealing the illicit money in foreign bank accounts in Hong Kong. The ruling was issued on September 12 by an intermediate court in Jinan City of Shandong Province. It said, the amount of bribes Wang accepted was particularly huge, the circumstances of the crime were particularly serious, and the social impact was particularly bad. At 64 now, Wang will spend the rest of his life in jail with no possibility of commutation or parole. The court made the sentence more than a year after Wang was investigated by China's top discipline inspection agency. Wang is the top Communist Party official at China Life. He is the latest top executive in a growing line of financial sector leaders punished for corruption. More than a dozen big names have been brought down in Xi Jinping's anti-corruption purge on China's financial sector. The list also includes Li Xiaopeng, former chairman of financial conglomerate China Everbright Group, Lu Liang, former chairman of Bank of China, the fourth largest lender in China. Prior to February, Bao Fan, a high-profile banking billionaire who went missing. He is believed to have been caught up in the dragnet. Lai Xiaoman, former chairman of a state-controlled asset management company who was executed after being convicted of corruption and bigamy. Xi Jinping conducted the crackdown on the financial industry several months after he secured a third term in October 2022. China's real estate woes deepened, Sino-Ocean Group suspended offshore debt payments. China's real estate woes deepened on Friday, September 15, as state-backed developer Sino-Ocean Group Holdings suspended debt payments for all offshore debt until a restructuring was finalized. It also said it has halted trading its US dollar securities in Hong Kong. According to the Beijing-based property developer, holistic restructuring of its offshore debt is the only way forward as it confronts rising liquidity challenges due to a sales slowdown throughout the wider sector since 2021. The company said in a Hong Kong Stock Exchange filing, starting from the second half of 2021, the real estate sector in China has experienced significant changes and real estate developers have been confronted with unprecedented challenges with regard to liquidity and funding. While Sino-Ocean Group continuously adopted measures to repay the debts, according to the filing, since 2023, in the circumstances where the industry sales and financing environment have not been notably improved, the group has experienced a rapid decline in contracted sales and increased uncertainty in asset disposals and has continuously faced limitations in various financing activities. It said, against the above backdrop, the group believes the optimal path forward is a holistic restructuring of its offshore debts, one that ensures fair and equitable treatment to its creditors, provides a sustainable capital structure, and establishes a runway for the group to stabilize its operations. Earlier this week, the price of some of Sino-Ocean Group's US dollar bonds fell to less than 10% of face value, according to FactSet data. Previously on July 26, Sino-Ocean Group had sought to defer interest payments for 3 months on 3 US dollar notes due in 2024, 2027, and 2029 with a principal amount of $1.8 billion US dollars. On August 17, it was announced that 3 coupon extension plans for US dollar bonds were passed. On August 14, Sino-Ocean Group announced that one of its $20.94 million maturing USD bonds failed to pay interest before the end of the grace period, resulting in a default, and it was seeking to be exempted from the default. In August, Sino-Ocean said that its creditors had rejected the company's plan to postpone repayment of a 2 billion yuan, about $278 million, onshore bond but agreed to give the company a 1-month grace period. On August 18, the group released unaudited financial information for the first half of the year, showing that the company suffered losses of more than 18.3 billion yuan and total liabilities of nearly 200 billion yuan. In recent months, state-backed real estate companies such as China Construction Real Estate and Greenland Holdings have also defaulted. Although Sino-Ocean's financial issues have been simmering since last month, the revelation on Friday sent China's already troubled property sector into a deeper debt crisis. Ensuring timely deliveries. The now troubled developer, which claims to be one of the top house sellers in Beijing and Tianjin with more than 600 property projects across China, does not foresee any delay in deliveries or disruptions in operations. Sino-Ocean is pursuing significant cost-cutting and efficiency improvement efforts to improve operating efficiencies. The filing said, at this stage, the group is working relentlessly to ensure delivery of completed properties pursuant to pre-sale arrangements entered into by the group and the continuation of its business operations. It added, the group will concentrate all necessary resources to ensure delivery of current projects, to accelerate the sale of properties under development and completed properties and to stabilize its business operations to protect the interests of the home buyers, the group's partners and all stakeholders. The company also announced the appointment of Houlihan Lokey, China, Limited as finance consultant and Sidley Austin as legal counsel. Property woes to continue. Sino-Ocean's problems add to growing concerns about China's real estate sector, which faces new challenges almost daily, including a continual loss of homebuyer confidence. The National Bureau of Statistics' 70 city house price data released on Friday revealed that the weighted average property price in the primary market fell sequentially in August after seasonal adjustments. The decline in sequential growth of house prices was most prominent in Tier 3 and Tier 4 cities, while the proportion of 70 cities that experienced sequentially higher property prices declined in both the primary and secondary markets in August. On Thursday, September 14, Moodys downgraded its outlook for China's property sector, given that weaker economic growth prospects and concerns over on-time project completion and delivery will continue to weigh on homebuyers' confidence and demand for the next 6 to 12 months, according to its estimates. Sino-Ocean is unsure if it will be out of the woods soon. Many factors outside of the company's control will need to be in place for a comprehensive solution to the offshore debt issue, the filing said. Given the lack of certainty, the company advised holders of securities and other investors to consider the relevant risks and exercise caution when dealing with them. Moody reduced China's real estate rating to negative. International rating agency Moody's lowered the outlook for China's crisis-hit real estate industry from stable to negative on Thursday, September 14. The ratings agency said challenges to economic growth will continue to dampen property sales despite government support. Moodys said it expects China's housing contract sales to fall by about 5% in the next 6 to 12 months, and that the impact of the Chinese central government's stimulus measures on home purchases may be short-lived and uneven. The outlook downgrade comes amid a series of debt defaults by cash-strapped Chinese developers. China Evergrande Group, the world's most indebted real estate developer, is at the center of the crisis. The crisis has also hit Country Garden, China's largest private real estate developer. Country Garden has been trying to avoid default and recently won creditor approval to extend the repayment terms of several onshore bonds. Moody's analyst Cedric Lai said in a statement that Moody's rated Country Garden as CA with a negative outlook, and its credit pressure has intensified investors' risk aversion. The major setbacks for Country Garden and Evergrande further weaken a property sector already hurt by the COVID-19 pandemic and China's broader economic slowdown. On August 31, Moody's lowered Country Garden's corporate family rating, CFR, to CA from CAA1 and its senior unsecured rating to C from CAA2. The outlook remains negative. The People's Bank of China, the central bank of the Communist Party of China, announced on Thursday that it would lower the bank deposit reserve ratio for the first time since March, as the world's second-largest economy grapples with post-COVID headwinds and a slowdown in the key real estate sector. Moody said real estate sales will fall the most in economically weaker cities. The report said, regions with weaker economies will account for most of the expected sales declines, as well as continued population exodus. Why foreign investment is leaving China and what it means. Foreign investors are fleeing China. Portfolio investment that flows into traded stocks and bonds has turned negative, as well as foreign direct investment, which goes into building plants and businesses. Why have investors suddenly turned so negative on China? What impact will this have on the longer-term Chinese economy? These questions were answered in the article Why Foreign Investment is Leaving China and What It Means, published September 16, by Mr. Christopher Balding. Mr. Balding is a specialist about China and used to be a professor at the Fulbright University Vietnam and the HSBC Business School of Peking University Graduate School. Whether China or other investments, there is no single reason but a host of reasons an investment is either made or rejected. Investors, whether hedge fund managers or multinational corporations building a plant, are motivated by money. For years, the Chinese market has been seen simultaneously as an instant money maker, and the market is continually just out of reach. Companies operating in China typically had to enter into joint ventures or turn over their competitive edge, such as technology, which many quickly found siphoned off into other companies or competitors. Foreign banks and asset managers always anticipated the grand market opening that had never come, where they could compete for business. Chinese bureaucrats were skilled at offering just enough to keep businesses interested but rarely giving anything of substance. Foreign investors looking to invest in Chinese stocks have learned the hard way that Chinese stocks have been roughly flat for 20 years. The first problem China faces is that too many investors have been burned in China. Politics has contributed to the outflows. Before Xi Jinping took office and even in the early years of his rule, foreign businesses operating in China made enough money to compensate for the risks and trade-offs necessary. However, to use a clean dividing line, with the fabricated detention of the Canadians Michael Spavor and Michael Kovrig, the approach to foreigners and foreign business changed. After the global financial crisis, a China posting by an ambitious junior multinational company executive was seen as a requirement for an aspiring senior executive. Coupled with the cushy pay packets, business and labor were anxious to take the first flight out. With businesses required to provide government access to pretty much all technology, internal emails and networks, draconian national security laws, and a highly protected market, the multitude of risks facing foreign businesses has driven many to say the difficulties are just not worth the potential profits. Chinese business faces the gravity constraints of the state. A Chinese business will remain a Chinese business. An international company deciding where to invest, source from, or build has many options, including Vietnam, India, Germany, and the United States. China now has to compete for international mobile capital. So far, it does not appear to be interested in competing. So what are the implications of foreign investment leaving China? None of them are good for China or the rest of the world. China benefited enormously from opening its markets. From the spillover effects it gained from local firms and workers competing against and working for foreign firms to the flow of technology and hard currency, China gained significant benefits from direct interaction with foreign business and trade. With foreign business and investment looking for other destinations, there are a number of clear implications. First, companies will become less of an advocate for China. In reality, China outsources many of its quasi-lobbying efforts of democracies to companies and institutions in the country. It will be much harder for businesses to lobby their representatives or other companies when they go elsewhere. Second, look for investment and trade to diversify away from China and into other countries. India and Vietnam, as well as other Southeast Asian destinations, are benefiting from companies leaving China. International trade and investment do not vanish, they seek new destinations. Third, expect China to become increasingly restrictive on existing business and investment, both domestic and international, whether it is entering or leaving. The People's Bank of China just recently announced verification measures for even state-owned enterprises making purchases of US dollars over $50 million. Though many expect China to reverse course and seek out international capital flows, this simply does not grasp the nature of the situation in China. Fourth, expect China to continue to experience weak productivity growth. Foreign enterprises, and even private Chinese enterprises, are the most productive and innovative businesses in China. With private enterprises and foreign businesses pulling down or facing sharp restrictions, this will hamper innovation and depress already low productivity growth rates. Do not expect China to stop growing, however, nor should we expect a healthy, dynamic, competitive economy. Fifth, as investors leave, expect Beijing to tighten restrictions on foreign exchange transactions. The Chinese are already utilizing various methods to help move US dollars out of China or ensure they never enter, causing headaches for the Chinese foreign exchange regulator. China desperately needs US dollars to keep international trade flowing and money growing. This means regulators will continue tightening up on trade and capital flows to ensure they achieve their desired balance. If they are not getting as much from abroad, that means they have to stop sending it abroad. That will only get worse. Investors are not making money in China, and the politics just compounds the risks, which are unlikely to change anytime soon. As money finds other destinations, expect more continued tightening and inefficiencies as China becomes more ossified. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.